Hi, my name is John Dowdy, and I'd like to give you a quick review of the stock market for the week ending August 16th, 2013. This is entitled A Market in Transition, and we'll be discussing if the action last week, which was a 2% loss, is something that is just business as usual, or is the market about ready to do a major reversal. After viewing the video, if you'd like more data, please come to my website, www.superchargedretirementIncome.com. Now, the analysis that I'll be discussing today is based on technical analysis, which is the analysis of charts. And some people believe in technical analysis and some people do not. If you'd like to see why I believe technical analysis does work in some cases, then please come to my website for a recent post. It's free, and I talk about why I believe technical analysis does work in some situations. Today, as I said, what we'll be talking about is a market in transition. Are we making a double top, or is the 2% loss that we had last week just a pause that refreshes? Okay, let's take a look at the market. What we're looking at is SPY, which is the ETF for the S&P 500. And as we look at this chart, we can see there's a green trend channel that's been in effect since last November. This is pretty well contained the stock market. We went above it a little bit in May and then dropped below it a little bit in June. But pretty much the market has stayed within this channel, and it is still within the channel. We were above the recent high, that was the May high, and this area 166 to 169 was a support level. And as long as we stayed above it, that was support, and we were hoping we would bounce off of it. But last week we did not bounce. We cut through it very sharply on Thursday and Friday, all the way down to the 50-day moving average. So this support area has now turned into a resistance area, and in order for us to relax and believe that the market is well, the bull is strong, then we will have to close back above this area, and that may take some doing. We'll have to see what the market does. Right now we're sitting right on top of the bottom of the trend channel and also at the 50-day moving average. We closed just a hair above the 50-day moving average on Friday. We closed at 165.83. 50-day moving average is at 165.73. So Monday should tell the tale. We'll either bounce from the 50-day or we will fall below it. If we fall below it, then we're looking probably at a decrease down to the next support level, which is around 155.73. That's the low in June. This should be fairly strong support because it's also right at the 200-day moving average. If we break these two, then there's a lot of program trading that will come in and drive the market, I'm afraid, much lower. So this is critical area down here at the 155 level. We have to hold that, and otherwise we may be looking at a much larger correction. As we can see, we have the 20, 50, and 200-day moving average. Right now we're focusing on the 50-day, but if this is broken, then the 200-day will be of utmost importance. What happens if we fall below the 50-day and maybe even below the 200-day? Well, we can get some idea by looking at Fibonacci retracement levels. This shows you the Fibonacci retracement since the November up to the high in July. And one thing is clear from this, you can see that the bull market really is not in jeopardy yet. We have not had a major pullback. I mean, we have not even pulled back 23.6%, which is the first Fibonacci retracement. This is very common to pull back to the 23.6% level. Even the 38 and 50% level will not invalidate the bull market. These are all common levels. And as you can see, we're still right way up above these retracement levels. So for a long-term investor, this market is still strong. The bull is still healthy. But for a shorter-term view, the risk-reward over the short term we have to watch the market carefully because that risk reward is not as great as it used to be. If we fall below the 50-day, then as we were talking about earlier, we could go all the way down to about the 155 level, and then we could go to the next level, which is the 50% retracement level down to 152, all the way down to the 61.8% level, which is 148. Now, 61.8% retracement is usually the last line in the sand. If you fall below that level, that should be strong support. But if we fall below it, we might go all the way down to the November low. If we break below the November low, then we're looking at potentially a bear market, because that's about 20% from here down to the low. So I don't think that'll happen, but we have to keep an eye on each one of these levels and make decisions as if the market bounces and the support holds, or if the market falls and the support does not hold. So the next week is going to be very interesting to see if we do get a bounce off the 50-day, and if not, where do we start bouncing from? So just a quick summary. The bull, as we said, lost 2% last week and is in danger of becoming even weaker, especially if we fall below the 50-day. The previous support levels, 166 to 169, are now resistance. There are no bullish or bearish patterns to speak of currently in play, so we just have to wait and see what develops next week. We're hanging on to that 50-day level by a thread, and it would not be surprising to me if we close below it and went a little bit lower. If we fall below the 50-day, the next support is around 155, which is the 200-day moving average. That is going to be critical. That level needs to hold, or the bull will be in trouble. So for the near term, if you're a short-term investor, I would be very cautious and defensive. As we said, if you're long-term, then things do not look that bad. But over the short term, we may have some weaknesses developing, so caution and defensive posturing is advised, especially until we can see what the market action does, and try to get into a situation where risk to reward is a little bit better than it is right now. So a legal disclaimer: the contents of this video are my opinions, and they are strictly for informational purposes only. They should not be construed as any investment advice and are any offer to sell securities. You and only you should be making your investment decisions, and you should do your own due diligence. Investing involves risk of loss, and past performance, as we've often said, does not indicate future profits. Just watch carefully to see what the market does. So good luck. Thanks for viewing. We'll see what happens next week. And if you'd like more data, please come to my website, www.superchargedretirementincome.com. Thanks.